Hey guys, welcome to our channel. In this video, we have a discussion related to the concept of Operation Twist. The article is from the Hindu paper dated 30th June 2020, reads RBI schedules Operation Twist for July 2nd. Let's have a look on what's given in the news article. In the Operation Twist, RBI has decided to conduct the simultaneous sale and purchase of government securities under open market operation for the 10,000 crore rupees each. From this, you have to be clear that it is a simultaneous operation of sale and purchase of government securities, in which RBI is going to purchase long-term securities and it is going to sell the short-term securities in the market. Before going in detail about Operation Twist, we have to be clear with certain terms and the concepts. First is about government securities and its utility in the economy. Next one is about the difference between the coupon rate and the yield rate on the bonds. This operation is going to be in the form of the open market operation, so we will see the concept behind the OMO. Finally, we will see the benefits of this operation to the economy. Government securities are the financial instruments issued by the government towards raising a loan from the public. So Government of India will raise some money by issuing G securities. These securities is auctioned in the market by the RBI on behalf of the government. It is also a tradable instrument, that is, these securities can be bought and sold in the secondary market. It has short-term securities and the long-term securities. Short-term securities is of less than 1 year. It is called as treasury bill. In India, we have 91 days, 182 days, 364 days treasury bill. Whereas long-term securities is of more than 1 year, like we have 5 years, 10 years and 30 years long-term securities. Long-term securities is also called as government bonds or dated securities. In case of India, the central government issues both the treasury bill and the bonds, while the state government issue only the bonds. That is, the state government will not issue treasury bills. Next one is coupon rate. It is a rate of interest that the bond pays annually. Let me explain with the example. Consider I am the government of India. I am going to sell a bond to you. Let me consider the value of the bond to be 100 rupees. On the bond, I will fix an interest rate of 10%. At the end of the year, I will pay you 10 rupees, that is 10% of value of the bond. This rate of interest is generally referred as coupon rate. I will explain it once again. On the issuance of bond by the Government of India, it will fix the interest rate on the bond. Coupon rate is a rate of the interest upon the bond which has to be paid to the owner of the bond annually. Next one is yield rate. Yield rate is a rate of returns the bond generates from the market. Let's consider the same example which we discussed. You have brought the bond from me, that is Government of India, with the value of 100 rupees. Now you have an option that you can trade this bond in a market. In the trading, you are selling this bond to someone in the market. Let's take him as X. In the trading, the value of the bond may increase or the decrease, that is above 100 or the below 100. It all depends on the supply and demand for the bond in the market. Let's take both the situation one by one. If the demand for the bond increases, then the value of the bond will also increase. Let's consider now the value of the bond is increased to 110 rupees from 100 rupees. At the end of the year, government will pay 10 rupees as an interest on the value of the bond to that X person, as he is the owner of the bond now. Instead of receiving 11 rupees, he is getting 10 rupees as a return, which is less than the 10% interest rate fixed on the bond by the government. So in this case, yield rate on the bond is decreased. Let me take the second situation and explain it to you. Let's say if the third person purchased the bond less than 100 rupees, but he will earn the same 10 rupees as interest on the bond. In this case, the yield rate on the bond has increased. So the market price of the bond will keep on changing based on the market forces of supply and demand, but the coupon rate remains the same. From this, you can understand that yield rate is inversely proportional to market price. That is, if the market price of the bond increases, then the yield will be reduced. If the market price is decreased, then the yield will be increased. Based on the yield rate on long-term bonds, the bank fixed the interest rates on the long-term loans. The Operation Twist undertaken by RBI is primarily aimed at managing the yield on the bonds. Therefore, you have to be clear with the concept of yield rate. Let's see the concept of open market operation. RBI will perform buying and selling of the government securities based on the market situation. The objective of the open market operation is to adjust the liquidity condition in the market. That is, if there is excess liquidity in the market, there can be a possibility for inflations. At that time, the RBI will sell the government securities and absorb the excess liquidity in the market. It is called as contractionary money policy. In the another case, if there is a need for increase in money supply, so RBI will purchase the government securities, thereby releasing the liquidity in the market. It is called as expansionary money policy. With increase in money supply, the bank will increase their lending capacity. So there can be the huge investment in the economy which helps in reviving the GDP growth. What is happening with the Operation Twist? It is not a new concept in the world economy. The US Federal Reserve then implemented the Operation Twist program in the late 2011 and 2012 to stimulate and revive the economy hit by the global financial crisis. This name is given by the US Federal Reserve Monetary Policy Operation. As we saw earlier, Operation Twist involves a simultaneous purchase and the sale of government securities. Here the word simultaneous is very important. Its main objective is to manage the yield. That is, the idea is to raise the short-term yield and to lower the long-term yield. We are going to see how this operation will result in rising of short-term yield and lowering of long-term yield. If the RBI announces that it is going to purchase long-term bond, then the demand for long-term bonds will be increased. As the demand increases, the market value of the bond will also increase. Then the yield rate on the long tenure bonds will be decreased. If the RBI comes with the sale of short tenure bonds, then the supply of the bonds will be increased. Whenever the supply of anything increases, the market price will be decreased. Thereby, the yield rate on the bond will be increased. This is the overall concept with respect to Operation Twist. But you may have a doubt on what is the need for the managing the yield. We all knew the present scenario in the economy, that is, due to the pandemic, there is a huge contraction in the growth. The government and the RBI is taking various steps to revive the demand and the production in the economy. In that way, the RBI has reduced the repo rate to the lowest ever, thereby pushing into the system around 4 lakh crore. Despite reducing the repo rate by RBI, the banks were reluctant to passing on to the customers. We can say in simple terms that bank has not reduced their lending rate. In this case, the RBI introduced the concept of Operation Twist to ensure the cheaper loan and accelerate the monetary transmission in the system. See this diagram. I have given the flow, that is, if the yield rate on the long-term bond decreases, then the interest rate on the long-term borrowings will also decrease. We have already discussed that the interest rate on long-term borrowings will be fixed based on the yield rate on the long-term bonds. Therefore, the bank will provide the long-term loans at the cheaper rate. In this way, there can be a possibility for the increase in investments in the long-term sectors like setting up of industries, housing, etc. Thereby help revive the growth of the economy. Then what is the need for selling the short-term securities? Over the month of the pandemic, the government and the RBI has released the excess liquidity in the market. Due to the liquidity surplus, the interest rate on short-term securities have been falling sharply. So RBI is undertaking this operation to balance the interest rate. Next important factors about the Operation Twist is that it will help the government in borrowing funds at the lower rate. Due to the lockdown, tax receipts of the government has been reduced drastically, so there is a need for huge borrowing from the market. With the Operation Twist, what we expect is that the yield rate will come down. So the borrowing cost for the government will also come down. In this way, the government can mobilize the fund easily. We have come to the end of the session. To get more clarity, you have to imagine yourself and relate various concepts in the economy. Enjoy yourself with learning new concepts. Thank you.